The Sydney and Melbourne house price correction has begun. Hello everybody, it's Leith Van Onselen here, the unconventional economist, chief economist at macrobusiness.com.au and the MB Fund, coming at you again with another macro breakdown where today I want to talk about the latest house price results from CoreLogic. CoreLogic has released Australian house price results for March, which showed that dwelling values across the 5 major capital cities rose by 0.3% over the month. However, results were mixed, with both Sydney and Melbourne recording falls, whereas Brisbane, Adelaide and Perth all recorded solid rises. Specifically, Sydney dwelling values fell by 0.2% in March and Melbourne's fell by 0.1%, whereas Brisbane's rose by 2.2%, Adelaide's rose by 1.9% and Perth's rose by 1%. Now it's clear from the data that both Sydney and Melbourne are moving into a correction phase. That is, after experiencing super strong growth over the pandemic, both markets are now experiencing falling house prices. This is shown clearly in the charts above. On the far left-hand side, you can see that Sydney's dwelling values have fallen for 2 straight months, whereas the middle chart shows that Melbourne's dwelling values have only risen once in the past 4 months. In fact, over the first 3 months of this year, Sydney dwelling values have risen by only 0.3% and Melbourne's have risen by only 0.2%. On the other side of the ledger, Brisbane's dwelling values continue to boom, rising by 6.6% over the quarter, and Adelaide's have risen by 5.8% over the quarter. So we clearly have a 2-speed housing market going on, with Brisbane and Adelaide booming, Sydney and Melbourne stalling, and Perth somewhere in the middle. It's worth pointing out that Sydney and Melbourne are both the most expensive and overvalued housing markets in the nation. As shown in the chart on the left, Sydney's house price premium to the other capital cities was 181% in the December quarter, which is close to its highest level in 50 years of data. While Melbourne's house prices aren't as overvalued as Sydney's, its relative house price against the other capital cities was 98% in the December quarter, which is still well above the historical average. Now, the reason why Melbourne's relative house price is only 98% is because the Sydney prices are so expensive. So, of course, Sydney pulls up the national average. Because Sydney and Melbourne are so expensive, this makes them extremely sensitive to interest rate rises. Earlier this week, Shane Wright, Fairfax's economics correspondent, noted that the futures markets are now expecting the Reserve Bank of Australia to lift interest rates from its current level of 0.1% to 3% by August next year. Based on the current New South Wales average home loan for an established house, which is $830,000, such a rate rise would equate to an extra $1,427 a month in repayments, or around $17,124 a year, which equates to about $25,000 in pre-tax income. Now, according to my own estimates, which is presented on the right, the 2.9% rise in interest rates would lift average mortgage repayments across the nation by 39%. This would mean that the typical monthly mortgage repayment nationally would rise by $1,025. However, monthly mortgage repayments across Sydney would be far worse at $1,571, and for Melbourne, monthly mortgage repayments would rise by $1,126. So what's the bottom line here? Well, it does appear from the data that both Sydney and Melbourne's property prices have entered a correction phase. And if the RBA was to hike rates as aggressively as the markets are tipping, that is by 2.9% by August 2023, then it's very likely that both Sydney and Melbourne would experience house price crashes, i.e. falls of more than 20%. My view is that because Australians are carrying so much debt and the impact from rate rises would be so severe, the RBA won't lift rates nearly as far as the markets are predicting. For what it's worth, I'm tipping a 1% increase in interest rates starting from late this year. Anyway, that's all from me today. I hope you enjoyed this quick video. Please make sure to leave a like and subscribe, and I'll see you in the next video. Thanks for watching.